Hi, everyone, and welcome to the Next Steps webinar. I'm Bob Beecher, CEO of MPTF, the Motion Picture and Television Fund. We're very glad to be able to present this webinar to you today with a fabulous panel of subject matter experts. Many thanks to our partners at the DGA for suggesting we pull together something like this for its members, and much gratitude to them for agreeing to open it up to their labor partners and others in the industry who are experiencing many of the same issues post-wildfires. Taking care of our own is the heartbeat of MPTF, and today we hope to make everyone better informed and a little more settled as we move into the recovery and rebuild phase, the next steps in this process. The last thing I want to say is call us at 323-634-3888 if there is any kind of you need during these challenging times. And please share this intake line with other industry members you think should be connecting with us. Let me turn it over to MPTF's VP of Legal Affairs, Sharon Siefert, who has done such a remarkable job in bringing this panel together today for you. Sharon will be our moderator and will be collecting any questions you have during the webinar to ask our panelists at the end. Sharon?
Thank you, Bob, and welcome everyone. Before I introduce the five experts joining us today, there are a few key messages I hope you take away with you. The first is that you're not alone. This webinar and the resources shared today will be available to digest later. Please don't feel like you need to take it all in now. And one other thing, we want to make sure you don't feel pressured by anyone into making decisions during this process before you're ready. Take your time, decide what's best for you and your family. Most people resolve their insurance claims without the need of a public adjuster or an attorney. Take advantage of the disaster relief centers that are open now and will be open for a while. Visit one. You may be surprised at the information available and resources available for you there. We really are encouraging you to seek that out. One last point from one of our board members who's very active in the local Red Cross here in Los Angeles is sign up with the Red Cross. They can get you benefits and resources that some other organizations can't, and it may and it doesn't hurt. It won't duplicate what you can get through Motion Picture Television Fund if you're in the entertainment industry. So really encourage you to do that. And they'll be pressing out different resources as they come through the city, for example, housing support services through 211. So please take advantage of that. So now on to our speakers. Our first speaker is Amanda Riddle. She's a managing partner of a firm in the Bay Area. For most of her career, Amanda has represented victims and survivors of utility-caused wildfires and explosions. She has served as the lead attorney in wildfire cases, including the 2018 Camp Fire cases, and represented clients in the 2017 Thomas Fire cases. She was an integral member of the team that negotiated a $13.5 billion settlement with PG&E on behalf of almost 70,000 wildfire victims, and currently serves as a member of the court-appointed oversight committee of the trust fund that holds and distributes those settlement funds. Through her representations of thousands of homeowners, renters, and businesses in these cases, Amanda has learned much about how to maximize insurance recovery following disasters. Stacy Monahan Tucker has been practicing law for over 24 years. She has a deep background in the insurance industry, and she represents policyholders and has expertise in wildfire victims assistance as well, securing millions in settlements in the course of her career. Michael Karlin is a longtime MPTF board member and founder of NKSFB, the largest business management firm in the country. Many of you on this call probably know of him and the firm. He's responsible for managing the business and financial affairs of many high net worth and high net income clients in the industry, the entertainment industry, and elsewhere. He's a CPA by background, so he brings that expertise for us today. We are also pleased to have a property tax expert, and this is a real niche for us lawyers. Cesar Reinoso has over 25 years of legal and property valuation experience and significant experience, in particular, assisting disaster victims. So that's a real unique experience, and we're really glad to have him here today. And then finally, Jennifer George is our own Director of Community Social Services. She's a licensed clinical social worker and is leading MPTF's efforts and response in supporting the entertainment community during this time of need. So as we discussed before, we'll take time for questions at the end. I wanted to let you know to write your questions in the Q&A area of our webinar. Or if you're watching on Facebook Live, you can post your questions in the comments. We will do our best to address questions that are coming up the most, but it is likely that we will not be able to address all the questions raised today, in particular, very fact-specific situations. So we encourage you to utilize the resources provided via our website and the updates in our newsletter. And some of the speakers today will be also making their contact information available for follow-up as well. I know that there may be a lot of questions in the area related to FEMA, and I wanted to let you know that there's a webinar with FEMA representatives that is co-sponsored by the Entertainment Community Fund and the Motion Picture Television Fund and many other industry organizations. And that will be announced soon, and the details will be provided on our Wildfire Relief webpage, so keep an eye out for that. Right now, I'd like to go ahead and turn it over to Amanda Riddle to provide some pointers on getting access to insurance benefits and navigating the process. For starters, Amanda, when should someone file a claim, and what kind of immediate help can a policyholder expect?
That is a very good question. You should file a claim as soon as possible. If you have not already filed your insurance claim, you should go ahead and do that. In these kind of disasters, insurance companies, as you can possibly imagine, are inundated with claims, and they tend to assign claims representatives on a first come, first served basis. And so the sooner you get your claim in, the sooner you're going to get help. You want me to just go from there, Sharon?
Yeah,
all right.
Thank you.
Good afternoon, everyone. I'm glad I can be here to share this information with you. As Sharon explained, my background is in representing homeowners, renters, businesses who have been impacted by utility-caused wildfires, namely SCE and PG&E. And through that experience, I have seen thousands, after the fact, thousands of insurance files and FEMA assistance files. And so that's where I've gathered a lot of my information. I got 15 minutes today to share information with you, but I know you've got a lot on your minds. Please let me know if you have any questions. MPTF has my contact information. I've told them that they can share that with you. You're welcome to follow up with me if you have any questions that I didn't answer. So one of the things about making your insurance claim is when you do initiate an insurance claim, the insurance company has 15 days under the law to assign you a claims rep. So again, the sooner you initiate your claim, the better. Context here, because of the magnitude, there are going to be a lot of insurance claims reps who don't generally do this for a living full time. They are going to be contracted by the insurance companies. So you may end up with an insurance claim rep who is not familiar with the Los Angeles area. They may be in Arkansas, they may be in Oklahoma. And so understand that there's going to be some advocating, regardless of who your rep is, on your behalf, because they're not going to be familiar with the area. They're not going to understand that, even though it's 15 miles from West Hollywood to Pasadena, that's an hour drive. And so that's not an appropriate place for you to be relocated to. So understand that there's going to be a lot of insurance claims reps who are going to really need to be educated on what you're experiencing. So when you open your claim, and you get your insurance rep assigned to you, the first thing that you want to do is ask for a copy of your insurance policy. You want to ask them for a copy of the policy, which is the contract that you have with your insurance company that goes over all the coverages, all your rights, all the insurance company's obligations. So that's the policy. You want to ask for a copy of your declarations page, which is kind of a 1 or 2 page document that lists all of your coverages, what your limits are for each area of coverage. You want to also ask for any riders or endorsements. Those are special add-on coverages that you may have. A lot of people do that if they've got, antiques or rugs or jewelry that are outside the regular limit on the policy. So again, ask for all policies, declarations pages, and riders and endorsements. The 15-day rule applies to that too. If you ask for those, your insurance company has to provide you that information within 15 days. So that's another good reason to communicate with your insurance company in writing, because it'll help trigger these 15-day time limits. So it is fine to talk to your insurance company over the phone, but you should always confirm your communications with them in writing. That's because, again, you want that 15-day time limit to be ticking without any confusion. You want to avoid misunderstandings in your communications, but also, like I said, you may end up with a claims rep who's not permanent, who's just a contractor for the first couple of months, and you want to make sure that your communications are put inside your claim file, and that's easier if they're in writing. So confirm all your communications in writing. Once you get that policy, you're going to want to read it. You're going to want to understand what all the rules are, what all the coverages are, what all your limits are. But one thing you really need to understand about your insurance policy is it is a contract. It is a contract between you and the insurance company that you pay for. And under California law, if you have a contract with someone, they need to treat you fairly, in good faith. They need to respond to you in a reasonable time period, and they need to act in a way that is not adverse to you. So your insurance company in this situation, as much as they may want to not pay you, as much as you may run into roadblocks, you need to remind them that you have a contract with them that you paid for, and that in return for your premiums and in return in that contract, they need to give you the benefit of the doubt. They need to treat you fairly. They need to treat you in good faith. And you need to continue to remind them of that, because I've definitely dealt with claims reps who act like it's their money and don't want to part with it. So you need to continually remind your insurance claims rep, if you're running into problems, I have a contract that I paid for. You need to treat me fairly. You need to act in my best interest. A lot of you have probably already made your insurance claim. I'm going to focus in on 2 of the parts of coverage that I think most of you are dealing with right now, which is loss of use, which is additional living expenses, and personal property. Stacy will cover rebuild and the rules around that, rebuilding your home. So both loss of use and personal property will apply to both homeowners and renters. Obviously, rebuild only applies to homeowners. So the most immediate thing you're likely facing is your loss of use costs. Loss of use is the costs that you are incurring because you are displaced from your home. So in the event that your house was a total loss, it was destroyed by the fires, then your insurance company, sorry, I'm looking over here because I'm reading, your insurance company is required to pay you in advance of at least 4 months of loss of use upon your request. So if you have not already gotten, if you have a total loss and you have an insurance policy, if you have not already gotten your 4 months advance, you need to tell your insurance company, I need my 4 months advance. At the end of that 4 months, they may well ask you to document what you spent it on before they give you any more. But for right now, you're entitled, if you have a total loss, to 4 months in advance of loss of use coverage. So get them to send you that check, because that will help you a lot. If your house was not a total loss, but you are under a mandatory evacuation order, then you are entitled to 2 weeks advance on your loss of use. So also ask your insurance company for that if you are in a situation where your house wasn't a total loss, but you're still under mandatory evacuation order. Some other arguments, I often have people ask me, my house wasn't destroyed, but I'm displaced. I can't go back. My insurance company is saying to me, oh, you can go back. So some other arguments, if there's a government agency that won't let you back into your home, which a lot of you are facing right now, that's one argument you can make to your insurance company to confirm that you are still displaced and that you should get loss of use coverage. If your home is still standing, but there's evidence of structural damage, and so it's not safe for you to live in, that's another argument you can make with your insurance company. And then the third thing is for your home to be habitable, you need clean water, you need electricity, you need gas, you need heat, you need a sanitation system that's running. So in those areas where the city is saying the water is not going to be safe to drink for a couple of months, where your gas and electricity have yet to be restored, those are some other good arguments to make to your insurance company of, yes, my home was not destroyed, but I am not able to go back to it, and you should be giving me loss of use coverage.
Amanda, real quick on the 15 days, there's a good question about, well, what happens if they're not being responsive? Like, what would you recommend? And is that 15 days or business days, calendar days?
It is 15 days. Stacy, is it business days, or am I correct that it's calendar days?
It is calendar days. You are correct.
Thank you. So it's 15 calendar days. Again, it's a good reason to put the communication in writing, so there's no question about when that 15 days started. If you are not getting a response from the claims rep, you need to escalate that to their manager. You need to, talk to a supervisor, for lack of a better term. And if you continue to get problems from the insurance company and they continue to not respond to you in a timely manner, then you need to report them to the Department of Insurance, the State Department of Insurance, because they are watching this situation very closely, and they have been much more, and Stacy will go over a lot of these rules, and a lot of these rules are with the code sections, with the legal code sections, are in the written materials that MPTF can hand out to you. But since 2020 and 2021, because we've had a wildfire problem in California, the Department of Insurance is a lot more, they're watching the insurance industry and their adherence to those rules a lot more closely. So if you report them to the Department of Insurance, they are watching. So back to loss of use. How do you track your expenses? You should track your expenses. One of the main reasons is there are a lot of resources, including FEMA, and I'll get more into it, but FEMA is very clear that any money that FEMA pays you cannot duplicate money that you got from another source. So you want to be very careful in tracking your expenses and making sure that you know what money was spent from what source, so that FEMA is not saying you took money from FEMA when you already had another source for that fund. So get receipts for the stuff that you spend the money on. and not the charge slip. You want the itemized receipt. I'm sure you've experienced, finding old receipts in your house. You know that ink fades. So it is a good idea when the receipt is fresh to take a photo of it. You can create a photos folder in your phone. You can take a photocopy if you have that kind of access. Worst comes to worst, you can jot a note down in pen that's not going to fade of, the date, the expense, and the amount. And then there's a lot of, sorry, already losing my voice 10 minutes in. There are a lot of apps that you can use to track expenses. I had a former fire client reach out to me, and tell me the other day that he used an app called Expensify to track all his expenses post-fire. So that's EXPENSIFY. It's Expensify. It's an app that you can use to track your expenses. Stay organized with your tracking of expenses. You can have a filing system, a different envelope for each type of expense to put the receipts in, different file folders. Even if you are normally an organized person, you're going to be dealing with, and you already have, dealing with an immense amount of stress and confusion over the next several months. So you want to make sure that you've set yourself up with a really good organized process. Sharon, I'm going to move on to personal property. Are there any other loss of use questions that came in that you want to share?
Yes, 1 second. So there was a question about loss of use when you're staying at a second home. Can you recoup it? And I think I know the answer to that, but I'll let you answer it.
So, well, the answer, like anything in the law, is it depends. So I've definitely had clients stay with family members, stay in a second home. There's a couple of arguments that can be made. First of all, if you're staying with family members, you're still likely incurring some costs. You're wanting to, contribute to the utilities, you're wanting to contribute to meals, that type of thing, because you're feeling like you don't want to put your family out. So you're definitely incurring costs there. If you're staying at a second home that you usually rent out, and so you are losing that rental income, then that's another good argument that you have a loss of use expense that you need replaced. I'm not costing you, $300 a night because I'm staying in a hotel insurance company, but I am still incurring the cost of the lack of income on the second home. So there are some creative arguments that can be made. Any others, Sharon, before I move on to personal property?
I think there was a question about, Jen, was it about 2-week advances and deductibles? I'm not sure I got that question, but.
Yeah, I think that question has been satisfied.
Okay, great.
There's a question about how people get current news about the state of their dwelling if they are out of state.
Current news is they're out of that's something that, well, there's a couple ways. I know that the city is already putting out lists on the state of whether or not a house is destroyed. So check with your local officials on that. On the Eaton fire, I know that CAL FIRE is already starting its DINS report, which is short for Damage Inspection Report, DINS, they call it. And in that, they go property by property, and they create a report. Is the property destroyed? Is it 50% damaged? Is it less than 50% damaged? Is it smoke and ash damaged? And so I heard yesterday that the CAL FIRE has shifted resources towards starting its damage inspection report. So hopefully that will be done and available soon. But I think right now, you've still got, all of the fires are still continuing to burn. So it's a little bit hard for people to really find out their specific property. But I think probably your city officials are the best place to do that until CAL FIRE puts out its report. So let me move on to personal property. I don't want to take up everyone's time. Personal property inventories. So for those of you who lost or have damaged beyond repair content. So personal property is the contents of your home. If you think of your house like a dollhouse, if you turn it upside down, all of the stuff that falls out is generally your personal property. It's not attached to your home. So your clothes, your furniture, your housewares, toys, that type of thing, sports equipment, that type of thing, your stuff, in other words. So in the event of a total loss, where there's a state of emergency, which we have a declared state of emergency in these fires, so that criteria is met. If you have a total loss, your insurance company needs to pay you out 30% of your policy limit for your dwelling as an advance on your personal property if your home was furnished. So let me break that down. So if you have a total loss, if your home was furnished, if there's a state of emergency, which there is, your insurance company has to pay you an advance on your personal property loss. It comes out of your personal property coverage, but the calculation is that it's 30% of your dwelling coverage. So if your dwelling coverage is $500,000, 30% of that is $150,000. And so the insurance company, assuming that your cap on your personal property is not lower than $150,000, has to pay you $150,000 as an advance on your personal property loss. And the cap on that advancement is $250,000. So you can get that advance, comes out of your personal property, the calculations based on your dwelling coverage. It's kind of confusing, but tell your insurance company, I want my 30% advance on my personal property loss. I have a total loss, my house was furnished, and we have a state of emergency. Your insurance company, after that amount, may require you to do a personal property inventory. Some insurance companies aren't doing that. They're saying, we'll just pay you 75% of your personal property coverage. You don't do a personal property inventory. We don't have to pay you 100%. We call it quits. For some people, that is a good avenue. It's what's best for them. As Sharon said at the top of the webinar, you've got to do what's best for your family. That's going to be a little bit different for everybody. So for some people, they're saying, I'm just going to take the 75%. I don't want to be burdened with a personal property inventory. Others are going to say, I want to do the personal property inventory. I will say that if you intend or you have thoughts of getting involved in the lawsuits related to these fires, the more documentation, the more detail you have of your losses, the better. And the sooner you do that, what you do now will help you down the road in those lawsuits. So keep that in mind. But if your insurance company requires you to do a personal property inventory, you can bulk categorize your losses. So you can say, instead of, writing the name and title and author of every book, you can say 20 books, X dollars. So you can group your stuff together if it's too impractical to list everything individually. So some tips on how to do a personal property inventory. First of all, you need to know under your insurance policy, do you have actual cash value, which is the value of the property before the fire? So if you had a couch that you bought 15 years ago, it's the cost, it's the value of that couch at the time of the fire, a 15-year-old couch. Or do you have, that's actual cash value, or do you have replacement cost value, which is the cost of going out and buying a new couch? So you need to know if you have, which one of those you have, but, and then you list the values in the personal property inventory of what the value was, either the actual cash value or the replacement value. know that your insurance company is going to knock some amount off of your inventory. They tend to depreciate everything by at least 30%. So if you're listing everything and you hit, say your cap is 100 grand and you hit 100 grand, keep going, because your insurance company is going to take that $100,000 and turn it into $70,000 by applying depreciation. So do not stop when you hit your personal property limit, because you're not going to be able to get your limit from the insurance company if you do that. So some of the tips that we have found useful in the past, when you're doing a personal property inventory, go room by room. So you can either do a list for each room, or you can do an Excel workbook where there's a worksheet for each room. And then that way you can go back to it each time you remember something. And if you go room by room, it's easier to visualize what you lost. It's easier to think what was in this closet, what was in this drawer. As you can imagine, doing that is very emotionally taxing. And so take your time, take breaks. That's why it's good to have a list room by room so that you can go back to it. Sharon, was there a question?
No, I'm just mindful of time and thinking that we probably need to move on to Stacy.
Okay.
Last points that you want to try to work in? I know there's a lot.
Yep. So personal property inventory, another way to do it is to ask family members for photos of events they had at your house. You'll be able to see, and then also look at, you probably got photos in your phone. So I just want to touch on one thing before we toss to Stacy. FEMA. So Sharon said that there will be a FEMA webinar coming up. You should definitely listen to that. FEMA is tricky. It says it on their website, but not clearly enough. They've said it in news articles, but not clearly enough. FEMA dollars cannot duplicate money that you get from another source. That includes insurance, it includes GoFundMe's, it includes Red Cross, it includes MPTF assistance. So make sure if you're taking funds from FEMA that you don't have another source for those funds, because FEMA will come back and they will ask you for their money back. So that's my caution on FEMA.
Okay, and then along those lines, one of your other recommendations was to be clear about how you're spending that money so you can segregate in, sort of maximize the different sources of benefits that don't end up duplicating FEMA.
Absolutely. I mean, frankly, I will tell you, I've worked on, I think, 12 wildfires and disasters now. I have never seen this much of an outpouring of support and this much assistance available. So I would go to all of those resources if you have insurance, if you have other resources before you go to FEMA, because it's not worth taking the $700 from FEMA and getting yourself in a pickle.
All right, thank you. Stacy.
Hi. I'm going to talk a little bit about rebuilding and the various insurance regulations and departments that are available in California specifically to protect you.
And Stacy, can I also ask you to, there was a question that came up about the California Fair Plan, and it sounds like they're not as user-friendly to deal with. So if you could address that too, that would be, any tips about that?
Absolutely. I've actually had a lawsuit against Fair Plan, so I'm very familiar with them. Okay. I'll talk about Fair Plan at the end, since there are some things that are unique to them. For rebuilding, as you look at your policy, your coverage A is your dwelling limit. That's the base amount that you're supposed to have to rebuild your house. Most of your other coverages are determined as a percentage of coverage A unless you specifically asked for something else. Your policy may have extended replacement coverage. Most insurance companies have stopped offering guaranteed replacement coverage in California, which means they'll pay however much it costs to rebuild your house, no matter what the cost. Now, instead, they offer extended replacement coverage, which can pay, depending on what you select and what they offer, an additional 25% of your coverage A, or 50%, or even 75 to 100%. Your policy only requires your insurer to rebuild your home as it existed at the time it was destroyed. Your insurer is going to ask for specific information about what your house was like at the time, and they're going to calculate their understanding of what it would cost to rebuild that house. That is what they are going to base their determination of what they're willing to pay you. If you come back with a wildly different architectural plan and want to build something completely different, and it ends up being much more expensive than what they anticipate it should be, there will be pushback. Also, your policy may have something called code upgrade or ordinance coverage. That allows the insurance company to give you extra money to meet today's code requirements. Like I said, the insurance company is only required to put your house back the way it was. The way it was built, especially if it's an older home, may not meet today's building codes. That is not their problem unless you have code upgrade / ordinance coverage. So that's what that coverage is there for. It's there to be put towards meeting the new building code standards that likely didn't exist when your original house was built. It can be a significant expense. It can be hundreds of thousands of dollars, especially if you had an old home. If your dwelling limit is not enough for you to rebuild, you can combine your dwelling and other structures coverage, including building code coverage and extended replacement cost, to rebuild your home. That's a new regulation. It's insurance code 10103.7. Previously, you weren't allowed to combine them. Now you can. That's was put in place because of all the fires and the massive number of people who are underinsured. Also, you don't have to rebuild. You can take the full limits of your coverage and purchase a new home elsewhere. However, to be clear, that's not as simple as telling your insurance company, I'd like to rebuild, please give me all the money. What you need to do is demonstrate that you would need all of those coverages to rebuild your existing house. Then you have to get under contract for a new house that costs whatever amount you're going to spend and give the evidence that you're under contract to the insurance company. So it's multi-step. Even if you don't want to rebuild, you need, if you want to access coverages beyond your base coverage, you need to get a contractor's estimate that will show how much the contractor estimates it would cost to rebuild your house. The insurance company is then going to compare that to their own estimates. I will tell you right now, their own estimate may be a lot lower. That's going to be quite possibly the first major dispute you have about rebuilding with your insurance company. They use their own proprietary software and insist that it's right, despite what multiple other contractors may tell you. So that is something you should be prepared for. If you are able to get your insurance company to agree that it's going to cost an amount that includes your coverage A, your extended replacement coverage, your building code upgrade coverage, your other structures coverage. If everyone agrees it's going to cost you all of that to rebuild, then you can get under contract for a house in that amount and send the paperwork to your insurance company and they will reimburse you. It is not an easy or quick process to get this money. You will be able to get the amount that they say it will cost you to rebuild. They should be willing to pay that out pretty quickly. It's the additional money above that that becomes a sticking point. So be prepared for that. And if you have any interest in accessing that additional money, you will have to get a contractor estimate, even if you don't want to rebuild. So please be aware of that. Also, if your home survived the fire in a zone where most homes were lost, you likely still need to make an insurance claim because your home is going to have significant smoke damage and it may have structural damage from the high heat surrounding it. So don't assume that because your house is standing that none of this applies to you. You very well may need significant assistance in your home. That actually is an area that Fair Plan is known and has told the Department of Insurance that it disagrees with Department of Insurance regulations and has been refusing to follow them. The Department of Insurance states that the insurance companies are responsible for paying for cleaning smoke damage. And Fair Plan disagrees. Fair Plan says that their policy language only requires them to repair physical damage, and that cleaning doesn't constitute physical damage. So be aware of that if you encounter that issue. That could be a problem. Fair Plan also, as anyone who has it may already know, has a total cap on all of their coverages of $3 million. So that includes everything, personal property, coverage A, loss of use. Everything is capped at a total of $3 million. So given the areas in which homes burn down, many people with Fair Plan will likely find themselves underinsured. You should be aware, the rebuild process is a long one, especially in a major disaster like this. It can take 12 to 24 months to get a contractor. Meanwhile, your insurance company is telling you that you have to keep providing evidence that you are actively pushing forward on the rebuild. This is another area where you can have disputes with your insurance company. You're telling them that you can't move forward because of delays outside of your control, like debris removal, permitting, finding a contractor with availability to start work, delays in sourcing materials and labor. The insurance company, meanwhile, will say, that's not our problem. We're going to cut off your monthly additional living expense until you can show us you're rebuilding. Again, that's something the insurance industry has been arguing with the Department of Insurance about. The Department of Insurance has required that everyone have up to 36 months of their additional living expenses that they can access, plus additional 6 months extensions if they can demonstrate good cause for it. So be aware of that. I'm going to walk really quickly through some insurance regulations that are in place to protect you. Sharon, did you have a question?
Before we get there, I know there was one question which is probably on a lot of people's minds, which is trying to manage paying for rent in LA and a mortgage at the same time through this whole process. I certainly would encourage everybody again to sign up with the Red Cross and see what benefits they can find that way. Do you have any other recommendations on managing that challenge?
Talk to your mortgage bank, talk to your bank, talk to whoever holds your mortgage. Usually they want to work with you on this. They understand the situation that you're in. And if you do have insurance, you should be getting a monthly payment that at least covers whatever you're having to pay to live now. So you'd be able to keep making your mortgage payments and you'll be getting money for the new place you have to live now. That is ideally what they should be doing. And your insurance is required to pay the fair market value of your home. So they tend to calculate that by looking online at comparable options. There are companies that actually do this for them. If you disagree with what they calculate, pull your own comparables and send them to your insurance company and say, this number that you're giving me appears low. I should be getting more. And that's, again, another area of pushback where you can negotiate. Let's see. We talked about already, Amanda mentioned, your insurer must advance you 4 months of additional living expenses immediately when you lose your home in a declared state of emergency. You can use all of your coverages, including extended replacement and building codes, to build a new home or rebuild, if you can demonstrate that you would need them to rebuild. The insurer, if you buy a new home, cannot deduct the value of the land from that home from your insurance payment. That's another new regulation. We talked about that your insurer must make an immediate payment of at least 30% of your policy limit for personal property up to $250,000 or your personal property cap. You don't need to use your insurer's inventory form. They have their own forms, which I will confirm can be very confusing and difficult to use with pre-filled information that you can't change even if it doesn't apply to your situation. You no longer have to use those. They have to accept the information any way you provide it. You also no longer need to itemize your personal property. You're allowed to bulk list items. Your insurer has to acknowledge your claim and begin investigating within 15 days of notice. They have to respond to questions and letters or calls or emails within 15 days as well. You can get a copy of your claim file upon request. That's all the claims related documents that they have compiled. Sharon?
Sorry to interrupt again. So we also have a cohort of renters on with us today, and some that may not have insurance, asking questions on how to interface with landlords and to seek potential reimbursement for damages.
Unfortunately, if they don't have insurance, my understanding, and this is not my area of expertise, but what I have seen, I have seen landlord policies, and they don't cover the personal belongings of the insured. If landlord policies do not cover their insureds, they only cover fixing the building.
I think for purposes of everybody today, Bob, did you want to?
Yeah, I think the question that a few people have asked is, they're renters, the building is still standing, it's not inhabitable, it's going to need remediation. Is the landlord responsible for providing that?
The landlord is responsible for repairing the property, but the landlord is not responsible for covering their cost of living in the interim.
No, but if they have smoke damage in their apartment and stuff like that, that's part of the remediation, or it's going to be an argument.
I think I'd like folks to definitely take advantage of talking to some of the nonprofit legal aid groups that are out there in this area. They do a lot of work on tenants' rights and stuff. So we'll add that to our list of resources, because I think there's a whole lot of issues in this, and it's a little too complex to answer in a very short period of time. And I want to make sure. Yeah.
That is a fair point. But I can say that landlord policies cover the house, the dwelling, the property, the apartment. They do not cover personal property of the insured. So that I know for certain. It also does not cover providing housing for the insured while they're not able to live there.
Yeah. Okay. I think Stacy, if I could ask you to wrap real quick, and then we'll move on. Thank you.
Okay. Of course. Real quick, if your insurer assigns you to 3 or more claims handlers in a 6-month period, they have to give you a written status report, and they have to provide you one ongoing person as a point of contact with a direct means of communication to that person. Let's see, what else did I want to make sure you knew? Your insurer cannot cancel your insurance while your home is being rebuilt, and cannot charge you on renewal for the cost of your non-existent home insurance, but can only insure what's actually there on the property. And they have to offer to renew for 24 months after a loss caused by a disaster. The California Department of Insurance has publicly available on its website market conduct reports that it did between 2020 and 2023 on the major insurance companies in California and how they were responding to the wildfires and how they were helping their insureds. Most of them did very poorly, and some had to pay over $40 million in additional claims payments for things that they made mistakes on, especially underinsurance. And 2 other things to really quickly keep an eye on. If when you make a claim, your insurance company is going to review your application. They are allowed to do what's called rescinding your coverage if they feel that there were false statements made on the application. This often comes down to whether or not the home was legally owned by the insured. If the home was in a trust and the owners themselves are the named insureds on the insurance policy, some insurance companies are rescinding the policy, saying that it's a false statement. Some of them are doing it because there was a pool that wasn't mentioned on the application. Also, something we see frequently, people who were growing marijuana on their property, who thought that it was fine because of changes in state law. Fair Plan especially, the policy states that they will rescind and refuse to cover if the home was used for anything illegal under state or federal law. and we've seen rescissions for that as well. So be aware of that.
Yeah, so Stacy, in those scenarios, that's where you would want to get professional advice.
That is where you consult an attorney.
Yeah. Okay.
And I know we're out of time, so we can move on to the next.
All right. Thank you so much. Really appreciate it.
You're welcome.
I also wanted to mention to everybody that United Policyholders is a nonprofit that has done a lot of work in the area related to supporting insured folks in responding to wildfire disasters and other kinds of natural disasters. They have a webinar coming tomorrow at 5:00, kind of an orientation on insurance policies, but I would really encourage you to check out their website. They have lots of great resources and work to connect people and resolve issues. So that will be in the materials that MPTF shares on its wildfire website. Okay, so moving along, Michael, I know we're really running out of time, but if you could give some highlights on your thoughts of things people should be thinking about in the next maybe 6 months.
Good afternoon, everyone, and it's a pleasure to present to you today. I'm going to talk about three matters in the income tax arena that you will be affected by as a result of the fires. I could clearly speak for an hour or 2 hours just on those topics alone, but I'm going to summarize and kind of get through them quickly. I'm going to talk about tax filing and payment postponements. I'm going to talk about claiming a casualty loss, and I'm going to talk about debt forgiveness. So the main point is that, and this is really, really important, both the IRS and the California Franchise Tax Board have announced that there is a deferral. Taxpayers now have until October 15th of 2025 to not only file and pay any balance due from 2024. So there was a fourth estimate due a couple days ago. If you didn't pay it, you don't have to pay it till October 15th. You normally would pay a balance due to the IRS on April 15th. You now have until October 15th to make that payment. So if you expected to owe a balance due, my suggestion would be to set aside that money in a separate account, separate government treasury bill that would mature around October 15th, have those funds available, pick up that interest income. So that applies to your 2024 tax return, also applies to your 2025 estimated tax payments. So for those of you who needed to pay in tax payments quarterly, first one would have been due. There would have been 3 payments due by October 15th. You don't need to make any of those payments. And who does this apply to? Interestingly, this applies to taxpayers in Los Angeles County. Initially, the wording said taxpayers affected by the fire, but then the IRS came out and clarified it. It said, if you reside in Los Angeles County, you get this provision. So that's a big get. Further, if you live outside of Los Angeles County, but your tax records are located within Los Angeles County, meaning your CPA, your bookkeeper, your business office was inside LA, you likewise get that deferral till October 15th. This provision applies not only to personal tax returns, but to business tax returns as well. Also applies to payroll tax returns, but interestingly does not apply to the payment of the payroll taxes. Go figure. They let you extend the filing of your payroll tax return, but they don't let you extend the payment of your payroll taxes. So that is a real big get for taxpayers, is that they don't have to file and pay anything now until October 15th. These are very similar rules to what we saw with COVID. Secondly, what is a casualty loss? And how do you claim a tax benefit from a casualty loss? So a casualty loss is an economic loss as a result of a sudden event. Well, there's no doubt that the wildfires were a sudden event. And California and the federal have somewhat different rules with respect to what is a casualty loss and how you claim it. I'm only going to talk about the federal rules. Historically, California's come along at a later point and adopted the federal rules, but they haven't quite yet on the casualty losses. So President Biden designated federal disaster designation, and that means if you have a casualty loss, which I'll discuss in a few minutes, you can deduct it on your 2024 return or on your 2025 return, whichever you expect is going to give you the highest tax benefit. Certainly, if you claim it on your 2024 return, you'll get the benefit much quicker because it'll be more than a year from now before you file your 2025 return. I want to give an example, but the main point I want to make is that what constitutes a casualty loss? Well, your casualty loss is limited to the amount of your income tax basis, not the value of your property. I'm going to talk about that in a second. And a casualty loss does not include amounts for which insurance reimbursed you for. So those are two key points. So let me give you an example. You purchased a home 25 years ago for $200,000. You put $250,000 of improvements in that house over the last 25 years. This is something that's probably rather common to several of you on this call. Thus, your income tax basis is $450,000, irrespective of how much the property is worth. So that's the most that you can claim as a loss is $450,000. And that $450,000 would be reduced by any insurance that you receive. So in this example, the house is worth $3 million, is a total loss. You have $1 million of life insurance. In this simple example, you have no casualty loss because your tax basis is $450,000 and you received $1 million. And in fact, now you've received more than your tax basis and you have a taxable income event, which requires you to pay tax on that difference unless you reinvest that money to rebuild your house in what's called an involuntary conversion, Section 1033. And you have 2 years from the end of the taxable year in which the loss occurred. So you basically have about 3 years. And if it's going to be a slow time to get houses rebuilt in that period of time, I would expect the feds in California to extend that time. So that's one relief provision that you have, but be careful. Your house may be worth $3 million and you may have no insurance. Some people went without insurance, they had no mortgages and they went without insurance. And in that example, the loss would be limited to their income tax basis. So that is really important to know. And so the takeaway is casualty losses are limited to amounts not compensated by insurance. If you have insurance for the coverage for the amount of the losses, the amount of any insurance payout must be subtracted from the loss claim. The amount received in excess of the tax basis is taxable income unless you choose to rebuild, or if you sell the house, you get, or you sell the land, the insurance proceeds plus the proceeds from the sale of the land is a sale of the property, and the $250,000 and $500,000 exclusions apply as though you just sold the house intact. Since it was a presidential disaster designation loss, the loss can again be claimed on the 2024 return or the 2025 return. You can claim the loss whether you itemize your deductions or not. So you don't have to be a taxpayer that itemized their deductions. And if the amount of the loss exceeds your income in any year, you have a loss carry forward. So you don't lose that amount. So if you have $150,000 of income and you have a $400,000, $350,000 casualty loss, you have a carry forward of that amount. So you don't lose it, you just don't get it currently. So those are two really key provisions. One is the postponement for the filing of returns for personal and business returns and the claiming of a casualty loss. Again, these are really, really technical rules. and I encourage you all to contact your CPA and run your specific facts by him, her, and get the answers that are specific to your situation. Last but not least, I'm going to talk about debt forgiveness. So we're already hearing about mortgage lenders deferring payments, deferring 3 months of payments or 6 months of payments, adding them to the end. I haven't heard where lenders are yet canceling or eliminating part of the principal. Here are the general rules that would apply. If principal or interest is forgiven, you have taxable income, unless, this is a little tricky, unless the interest would have otherwise been deductible. So if a lender's going to say, your $1 million loan, we're going to reduce it to $800,000. In that case, you have $200,000 of income. If they're going to reduce your interest payments by $25,000 and those interest payments would have been deductible, you don't have income. If you are insolvent after the debt relief, then that's an exception and you don't have taxable income. And insolvency is measured by the decline in value of all your assets before the event and after the event. So general rule is that forgiveness of debt is taxable income. There's an exception to that rule if you have, if you're insolvent after the forgiveness. Deferral of payments. Now we're seeing, this is more common where we're seeing lenders defer payments. Deferral of payments does not give rise to a taxable income. Your mortgage interest deduction is based on what you actually pay to the lender, subject to limitations. So in terms of debt forgiveness, you could have an unintended tax consequence that you may need to plan around. So just be careful of that. Lastly, but not leastly, is that to claim these casualty losses on your tax return, you just do it by filing forms that will be attached to your income tax return, claiming the loss. If you itemize your deductions, it'll show up on that Schedule A. If you don't itemize your deductions, there's a special form, Form 4684, that you would report the loss on. Again, these are highly technical provisions. They could apply and they could give you some real financial aid at a time when you really need it. So that is my quick summary, but those are 3 key points that should apply to most of you and provide you with some benefit at this much needed time. Thanks, Sharon.
Thank you, Michael. Much appreciated. All right, we're going to switch now real quick to Cesar. Thank you so much. I know we've gotten definitely some questions asking about relief from property tax. Thank you.
Great. Thank you for having me. First, a few housekeeping items very quickly. For those of you who are out of state or haven't been able to get back into the affected areas, there is a website that the LA County just went ahead and put live within the last day or two. You can go ahead and reach that website at recovery@lacounty.gov. There, you'll be able to go ahead and look at properties affected by the fire. There are maps of the fire for both the Eaton fire and the Palisades fire. And the information is being updated daily, but eventually you will be able to see, if not already, your home. If you're out of state, the county has already gone ahead and taken photos of the damaged property that you can go ahead and see on this website. So hopefully that'll be informative for you. Property tax forgiveness or tax deferrals. Please go ahead and go to the assessor's website and download forms ADS 820 and ADS 820.3. Those are the calamity claim forms and the tax deferral forms, the property tax deferral forms, respectively. California Revenue and Taxation Code Section 170 allows the assessor allows the taxpayer to request that the assessor go ahead and reassess a property that has experienced a major misfortune or calamity, provided that the taxpayer files that claim within 12 months of the calamity date and that the physical damage to the property exceeds $10,000. It goes without saying that the Palisades and Eaton fires qualify as calamities in almost all cases, as damages to the property are likely to exceed $10,000, even if a damage to a property is relegated to smoke damage. In conjunction with Revenue and Taxation Code 170, Code Sections 194 and 194.1 allow a taxpayer who's filed a claim under Section 170 to obtain a property tax deferral. Under the law, taxes will be deferred until the assessor issues a determination of value pursuant to the taxpayer's claim. Under normal circumstances, this process can go ahead and take 4 to 6 months. However, Governor Newsom last week extended the tax deferral timeframe until April the 10th of 2026 to allow the assessor time to process the number of claims that will likely be massive. So how does a calamity claim work? Well, we look at 2 moments in time. First, what was the fair market value of the property the day before the fire? And second, what was the property worth the day after the fire? So in other words, what could you have sold your property for the day before the fire? And what could you have, what can you sell the property now after the fire? So what is the assessor going to look at? So the law requires the assessor to value damage to the improvements, to the land, and to personal property separately. Now, please note that personal property only applies if the damaged structure is commercial in nature. It doesn't apply to personal property damaged in a home that was been destroyed by the fires. So what if the improvements on your home are completely versus partially destroyed? If the home is completely destroyed, the assessor should remove all of the value associated with the improvements that is currently assessed from the tax roll. If the property is partially destroyed, let's look at an example. So let's say that the fair market value of your property,
I'll call you back.
let's say that the fair market value of your property was $2 million prior to the fire. And let's say that the assessors now determined that the fair market value of the improvements after the fire is $1 million. Percentage-wise, this goes ahead and is a 50% loss in value. So if your assessed value for the improvements was before $500,000, a 50% reduction in value would mean that your improvement value on your property taxes would be reduced by 50% to $250,000. What about the land? How can land be physically damaged? Well, there's the landscaping. How about the toxicity from burning materials that have permeated into the soil? The loss of all utilities at the property. We're telling our clients that as of the calamity date, as of the moment in time that the fire burned down these properties, the land was worthless. Why? Because no marketplace existed on that date. There are no comparable sales, there's no data, there's unknown damage to the soil, unknown amounts to cleanse the soil, no access to the properties, adjusters haven't been there, there's nothing. So what are the methods that the assessor can look at to determine the damage about the properties, regarding the property's fair market loss in value? Well, they can go ahead and look at comparable sales. They can go ahead and look at the cost to go ahead and rebuild the property. And if the property is commercial, they can go ahead and look at income that the property produces. Most of you have damaged residences, so the assessor will either look at comparables that have sold in the neighborhood after the calamity date, but that method is really non-existent because there is no market for these properties now. Nothing likely has sold. There's no empirical data that's available. So what does that leave the assessor with? That leaves the assessor with a cost approach. What will it cost to go ahead and repair or rebuild the home? Now, this is difficult, again, for a homeowner to ascertain at this point in time because many individuals haven't even seen their properties. How long is it going to go ahead and take for an adjuster to get out there? How long is it going to take to hire a contractor to go ahead and give you an estimate or two or three? I mean, are contractors even going to be available? Because now you are competing with thousands of other homeowners to go ahead and get a qualified contractor. And in addition, you're going to be looking at sourcing materials that may now be at a premium and cost significantly more than they may have a couple of weeks ago. Absent this information, I believe that the assessor is going to rely on information platforms such as Marshall and Swift to go ahead and obtain this data. These information data platforms are not necessarily precise, but absent this specific information about each damaged property, this is what I believe the assessor is going to do. So you file your claim, you have your tax deferral, now what happens? Well, 6 months, 9 months, 12 months from now, the assessor will issue a determination of what they believe the loss of your property's value is. If you agree with it, then great. Your tax bill will be adjusted to reflect the reduced amount, and moving forward every January 1st, the assessor will look to add value back to the property incrementally as progress is being made with regard to the repairs and the new construction on the property. So if, for example, by April 1st of 2026, a completely destroyed property is 20% rebuilt, then the assessor will add back that 20% that originally took off the property's assessed value. There is no time frame for completing construction or repairs. The assessor will just want to make sure that progress is being made and it's taking a reasonable amount of time. I believe that with thousands of properties, it will take longer to source materials and again, hire a contractor that you trust to rebuild your home. Now, if you do not agree with the assessor's determination, so maybe you have partial construction, you believe they haven't taken enough off the value of the improvements, or you believe that the land is not valued appropriately, this is the stage when many of you may need to have our office intercede on your behalf to fight the assessor's determined value. Getting the forms in initially is very simple. You can go ahead and do it on your own, but once the assessor comes back with a determination, that's when I may need to speak with some of you. If you purchased your home 40 years ago and you're benefiting from Prop 13, your property taxes are probably, no more than $10,000, $15,000 a year. If the assessor says that your value has dropped by 50%, your taxes will go down and there may still be an amount that you disagree with. However, this isn't a fight that I would recommend because, first of all, the reduction is temporary. And even if you want to get a larger reduction, it may cost you $20,000, $30,000, $40,000 to litigate this matter that is only on a temporary basis, and you're only maybe fighting for an additional $2,000 or $3,000 in additional deductions for a period of a few years. However, let's say you purchased your property in 2023 and you paid $10 or $15 million. That is a different story. Now, on just $10 million, with a 1.2% all-in tax rate, you're going to be paying $120,000 in property taxes. So in that case, it may make sense to go ahead and contest the assessor's determination of the loss in value. So finally, looking into the future, I really don't believe it's a stretch to say that the Palisades, Malibu, Altadena, Sierra Madre, parts of Pasadena won't recover, may not recover for 10 years. Once the repairs on your construction are completed, then what happens if the assessor will seek to go ahead and restore all the value of the property that you were once assessed at? What happens if even after you go ahead and finish completion of the home, the neighborhood hasn't rebounded, and you still need to go ahead and pay your taxes that are based on a value that's more than what the property is worth even after you finish construction? Then you would go ahead and have to file something called a Proposition 8 decline in value appeal to go ahead and further, litigate this further litigate the situation. That's way down the future, years from now, but you need to start thinking about these things now because this process, unfortunately, is going to be a marathon. I know I've covered a lot of information in this condensed period of time, and, should you need more information, my firm is here to help if you run into any issues. If something doesn't make sense and you just need to go ahead and ask a question, please call us. We'll be here for you. We're just a phone call away, and thanks so much for your time.
Thank you, Cesar. Much appreciated. I know we're running way late. Jen, were there any outstanding questions that you think we should bring to the fore?
I've been trying to shuffle questions to people directly.
Oh, great.
So, yeah, Sharon, I had one question. It was regarding a Proposition 19 base year transfer. So people that are over 55 have the ability to transfer their existing base year to a new property that they go ahead and purchase. In this case, the gentleman was asking, can I go ahead and transfer my base year property from my property now to a new property that I may purchase? Well, usually you have to go ahead and live in the property. You have your base year value, and you can go ahead and buy a piece of land. And then as long as you build within 2 years, you can transfer that your base year. Here you have the opposite situation where you want to go from maybe a home that's been leveled by the fire to a single family home. I'm not sure that it will go ahead and work. And even if it did, I don't think it would make much financial sense based on how the calculation works to transfer that base year value. I'd be happy to answer that individual's information or question. MPTF has my contact information and they're free to provide it.
Thank you. Jen, any other questions?
No, I think we're okay to move on. There are many other questions, but a lot of them get very detailed. So I'm trying to point them toward resources. And I would like to say we have a lot of questions about whether this webinar is being recorded. It is. It will be available on the website that you see on the bottom of your screen right now, mptf.com/wildfire relief, and also on our YouTube page tomorrow.
Sharon, if I could add one thing?
Yes, please.
So while everyone else was talking, I was going through the questions in the chat, and someone said they called FEMA this morning, and FEMA told them that the initial $770 payment is a no strings attached. There's not a concern about duplication. It's everything beyond that, which is great to hear because FEMA has been very unclear about that. So I do suggest that everybody, contact FEMA and get that confirmation for themselves. But it sounds like that 770, at least one person was told that's not an issue when it comes to accounting and with duplication.
Great. Thank you. And then we'll try to make sure that gets addressed in the FEMA webinar that we're going to be having with other industry groups probably next week, I believe.
I wanted to say really quickly, I didn't know this before. The Directors Guild is also going to be making this webinar available on their website. So if you're a DGA, you can look there tomorrow.
Sounds good. I know we ran out of time and Jennifer George wasn't able to speak. I think, what we really wanted to emphasize was that those of you on this webinar that are entertainment industry related, please reach out to our social workers at the number that's on the screen. And we can help you with navigating different issues. And I want to reinforce the value of the resources that are available on the United Policyholders website and the Red Cross to get you started. And just a reminder, take your time. There's gonna be more opportunities to get questions answered And I'm sorry if we weren't able to answer everybody's questions today. Bob, did you have anything else you wanted? I see your hand up.
Jen, I did want to mention one other thing, which is MPTF has some cottages available on our campus for those of you who have been displaced, lost your residences, maybe have Airbnbs or staying with families who want to get rid of you, or you want to get away from your family. So please contact us at that number and we will see whether we can accommodate you or not. We've got, I think, 5 or 6 cottages with industry members living in them now. We just furnished another 4 cottages. So please take advantage of this resource. It's a lovely campus. It's 3 square meals and a great environment. And I heard from one industry member who stayed with us over the weekend, and she said 15 minutes after she moved in, she realized that the person living in the cottage next to her was an actor that she had cast in a movie 30 years ago, and it went on from there. So it's a place where you will find friendly entertainment industry experience. So please contact us if you need that support.
And I did pick up one message that someone had trouble seeing the number on the screen. So it's also available on our website, mptf.com.
323-634-3888.
Well, once again, I really want to emphasize that this is a marathon and we're here for you. So don't be afraid to reach out. And I hope that all of you find moments of respite during this process. Hopefully each and every day. That's our wish for you. For those of you who enjoy poetry, there is going to be a Zoom link to Harry's Poetry Hour that's following this webinar that you are welcome to join. It's a lot of fun. Incredibly inspirational and often a balm. And then you can also find recordings of our prior episodes on MPTF Studios YouTube page. So with that, I think we're going to wrap. And I wanted to say thank you very much to all our speakers. We really, obviously couldn't have done this without you and appreciate all your time and wisdom.
Thank you. Appreciate you all.